Hello, everybody. We are tackling corporations today. Um, we've come on quite a journey. Principles one was sole proprietorship, small businesses, even the starter principles two. We've talked about partnerships in the past 2 weeks, but now we're going to tackle corporations. Um, some things we've been talking about really have to do with corporations. Depreciation, allowance for doubtful accounts. Generally, those type of things only are found with big corporations. But anyways, we're going to tackle the biggest part of corporations, which is stock. Okay, so every other law we've learned in accounting is applied to corporations. All the generally accepted accounting principles are part of what corporations have to follow. So we don't have to learn anything new besides stock. And then also, what comes with stock is dividends. There's a few different things that we have to take into account, such as different names for things we've learned, but there's not much else different in terms of the rules. So the biggest thing is instead of owner's equity, we have what's going to be called stockholder equity. Okay, stockholders. So when you buy shares of a company stock, they are the actual owners of the company. Okay, there's a CEO, CFO, COO. They all run the company. There's a board of directors who are supposed to represent the interests of the stockholders, but none of these people technically own the business. The owner of the business are the separate stockholders. So instead of owner's equity, we call it stockholders' equity. You might see it called shareholders' equity, um, any form of shareholder, stockholder ownership equity, you'll see it like that. So on the balance sheet, you'll have assets, liabilities, stockholder equity. Some new accounts we're going to be dealing with under stockholder equity are going to be common stock, preferred stock, and then these accounts called additional paid in capital. Okay, we're going to see that be more specific, but these are going to be equity accounts. Okay, and then another one, retained earnings. So, real briefly, retained earnings is the accumulation of years worth of net income or net losses. Okay, so if we just said real quick, this isn't the focus of my lecture today, but just to get the point across. If in 2011 a company had net income of 50,000, in 2012 they had a net income of 100,000, and then in 2013 they had a loss of 20,000. Sorry. Their retained earnings would be the constant accumulation of these three. So their retained earnings at the end of 2013 would be all this, 130,000. Okay, that's what retained earnings really is. Dividends. So if dividends are, if you've never heard of them, they're money shareholders receive from a corporation. Um, Generally, they're small. You might get like a $20 dividend if you own like a big stock. Maybe even every quarter you get that. So those are paid out of retained earnings. So you need to have a positive balance. Closing entries. When you think about sole proprietorships and partnerships, when you have revenues and expenses, you close them out with the income summary account, and then you put income summary to owner's capital. Well, with corporations, instead of income summary, you close out revenues and expenses right to retained earnings. And that's how the values go into this retained earnings account. So again, that's a stockholder equity account. I think I'm going to split this chapter into two again, um, which is fine. What I'm going to do today now is focus on stock. So let me start right here. Common stock. So there's two types of stock, common stock and preferred stock. Common stock is your normal stock a company issues that you could buy it for whatever amount you buy it for, that's it. Preferred stock is called that because it comes with preference for dividends. So preferred stock is shares of a company, but generally those shareholders, they have to pay a little more, but they get first rights at dividends. So if a company only issues a small amount of dividends, it'll go to preferred shareholders first, and then anything left over, common shareholders get a little bit of it. So again, two types of stock. It's ways to buy into a company. Common stock is the most normal type, nothing special with it, really. And let's just say a company issues 1,000 shares of common stock for $20 a share. So this is the most basic example of common stock. Okay. So in this case, a company is issuing 1,000 shares of common stock for $20 a share. We will always assume shareholders are buying stock for cash. Later on, you could get into things where you exchange assets for stock. That's an intermediate accounting. Don't worry about it now. So in this case, a company issues 1,000 shares of common stock for $20 a share. A company will always, where we are right now, debit cash, because that's what they're receiving. So again, we're the company. So shareholders are coming, they're buying these shares of stock, and they're giving us cash for them. So $20 a share times 1,000 shares, we're going to get $20,000. Now, what does the company credit? What they credit is the stockholder equity account, common stock, $20,000. And that's it. That is it. So it's nothing crazy. But what often happens is common stock has an attached minimum price to it called a par value. So when a company incorporates, so when they first become a corporation, they can and usually do assign a minimum value to their stock. Okay, so this means when it's out in the market, you see stock prices go up and down every day. Those are the actual market values of the stock. But what companies sometimes do is they assign a minimum value where it's kind of a protection for their stock not to fall below this value. So what companies will do is they'll assign this par value. So what you see more often than not is a situation like this. A company issues 1,000 shares of $5 par value common stock. The stock is currently trading for $20 a share. Okay? So we took it to a next level. 1,000 shares of $5 par value common stock. So the company's issuing 1,000 shares, and they assigned $5 when they incorporated a par value. So a minimum value of $5 to protect the value of their stock, so it can't be bought for lower than that. But the stock is currently trading for $20 a share. So that's what it's out for on the market. What do? From the company's perspective, we're still going to receive cash. So we're still going to debit cash. And we debit cash for the total market value. So the total market value will be the number of shares issued multiplied by the market value per share. So that's what we debit. Then we're going to credit common stock for the total par value. So it's going to be number of shares issued times par value per share. Now, if you look at that, you're going to say, hey, we're going to debit cash. Let me start it. We're going to debit cash. The total market value, $20 per share times 1,000 shares, $20,000. We're going to credit common stock for the par value. So 1,000 shares times $5 each, $5,000, you're going to say, yo, buddy, look at this. Credits don't equal to debits. You broke the number one rule of journal entry. We're not done with the journal entry yet. There's going to be one more credit. So what happens when a stock has a par value, but it has a market value that's different than its par value? You credit this other account I mentioned, additional paid in capital. It's another equity account. Additional paid in capital. We should be specific. So it really has a longer name. It's additional paid in capital in excess of par, and then you specify it's for common stock. So this right here is the full name of the account. And what you multiply this by is the number of shares issued multiplied by the difference between the market value per share minus the par value per share. So when we go down here, we're going to credit additional paid in capital in excess of par, common stock. Okay, you'll see after this one, I'm going to abbreviate like crazy because I don't feel like writing that all the time. And again, the official formula is going to be the number of shares, so 1,000 shares, times the market value of $20 per share minus the par value of $5 per share, which should get you $15,000. Okay. Now, again, when you're good at math, these don't get too complex. So you could just, in your head, say, hey, the difference is $15. $15 times 1,000 shares, $15,000. You could say, what do we need to make this journal entry balance? We need $15,000. So there's different ways to go about it, but the official calculation is this. And the official name is additional paid in capital in excess of par, and you specify we are working with common stock. How I will normally abbreviate it, I'll do a few things. I'll probably do, official abbreviations. So I'll do additional paid in capital, PIC, in excess of par, and then I'll do like a CS, common stock. Okay. As long as you have this generality in your answers, I'm happy. So again, this is an equity account. All it is it's taking your organization, so when you show stuff on your balance sheet, to the next level. So instead of showing this full 20,000 as common stock, what they're saying is we have common stock with a minimum value of $5,000 out there, but then we sold it for extra value of $15,000. That's how well our stock is doing. It's selling for $15,000 over the actual price, okay, in total, when we take all the shares combined. Okay, but again, they're both equity. So on the balance sheet, you would see it just like this. Stockholders' equity would be your title. You would see common stock, 5,000. Additional paid in capital in excess of par, common stock, 15,000. Sometimes companies, when they incorporate, they don't use a par value. But then when they issue their stock, they issue it with a stated value. And what a stated value is again, par value, you select a par value when you first incorporate. If you don't do it then and there, you can't select a par value. But what you can do is when you issue stock without a par value, most states allow you to assign a stated value. So if you're a successful company and then you realize that you made a mistake and you didn't assign a par value back in the day, but you don't want to risk your stock for selling for too cheap, you're allowed to, when you issue it, assign a stated value, which is, again, a minimum value assigned to the stock. So I'm going to tell you it has the same effect and purpose as par value. It just, par value is when you incorporate, stated value is if you want to add a value later on, and that's it. So if we do this, a company issues 1,000 shares of $2 stated value common stock, which is trading for $10 a share. Okay, it's going to be the same calculation we have here, right here, except instead of where you see par values, it's going to be stated value. So let me cheat and copy this. So we're going to debit cash for the same thing, number of shares issued times the market value per share. So when we do that over here, we're going to debit cash, and it's going to be 1,000 shares times $10 a share, or $10,000. We're going to credit common stock still. Okay, CS, common stock. Instead of par value per share, it's just going to be stated. So 1,000 shares times $2 stated value is $2,000. And then we're still going to credit additional paid in capital in excess of stated value now. It's just another way to organize things. So again, par value doesn't exist for this company, so we have to use stated value. And then we again specify common stock. Okay, I told you already, I'm getting lazy with it. So the formula, additional paid in capital, excess of stated value, common stock, number of shares issued still stays the same, market value per share minus stated value. So literally when you have stated value stock, you just change par value to stated value. So the formula, when we do it down here, let me move this over, is going to again be the 1,000 shares, total shares issued, multiplied by the market value, which is $10, minus the stated value of $2, you're going to get $8,000. Again, this is an equity account. It's just stating it in a different way. It's showing that it is the stated value. Okay? I'm trying to think of questions you could have just so I could answer them now. I think we'll use the discussion post for questions if you need on this a lot. So again, this first one we did on the first page, this is when the common stock has no par value and no stated value. So it's just out there on the market, so there's no additional paid in capital. The stock just sells for whatever the market says, and there's no minimum price with it. Then we say, hey, what if the company adds a price, a minimum value, when they first incorporate? That's called a par value. Here's the journal entry for that. Then we say, hey, what happens when the company doesn't issue a par value but realizes they want to assign a minimum value later on? That's what's called a stated value. Okay. So now we're going to move on and we're going to talk about preferred stock. And this will be the last topic. There's different types of preferred stock. That's, I think, what we'll talk about next week. Excuse me, so this doesn't get too complicated. There's different types of preferred stock. The different types are all based around the benefits that come with dividends. For now, just know preferred stock has dividend benefits. That doesn't affect when we issue preferred stock. So if we say a company issues 100 shares of preferred stock that is trading for $50 per share. Journal entry, just like with par value and stated value, preferred stock is journalized the same exact way. You just take out the word common stock and you put in the word preferred stock. It's really not that complex, I think. So what we would do from the company's perspective, we're going to debit cash for 100 shares times $50 a share, which is $5,000. Lost my math ability. We're going to credit preferred stock instead of common stock. Preferred stock is an equity account, but we are specifying that this is the value of preferred stock we currently have out there in the world. And again, if you want to see the calculation, 100 shares times $50, $5,000. So it's not different than common stock except for the name. But preferred stock is also an equity account. It's just categorizing it into what type of stock it is exactly. So I'm going to do all the preferred stocks on this page because you're going to see there's no change from common stock. So a company issues 100 shares of, guess what? You can have par value on preferred stock of $2 par value preferred stock that is trading for $50 per share. So again, par value with preferred stock is the same thing as for common stock. It's a minimum value the company assigns their preferred stock when they first incorporate because they don't want it to go below that value just in case stuff happens. So they're going to do the same thing. They're going to debit cash for the same market value, total market value. So 100 shares times $50 a share, $5,000. They're going to credit preferred stock for the par value. 100 shares times $2 a share, so only $200. Then they're going to credit the difference to additional paid in capital in excess of par preferred stock. I'll do PS, preferred stock. And again, that formula is going to be the shares issued, 100 shares, times the market value, $50, minus the par value, $2, so $4,800. Okay? Again, I told you, the process doesn't change except for the word preferred stock takes over where common stock exists. So you can have the same thing with stated value. A company issues 100 shares of $1 stated value preferred stock that is trading for $50 per share. So again, they didn't assign a par value back when it first incorporated, but now when they're issuing their stock, their preferred stock, they say they want a minimum value. Generally, stated values and par values are very small. Companies would be foolish to make them too high because then people don't want the stock in general. So usually they're $1 to $10 max. So debit cash for the full value, 100 shares times $50 a share, $5,000. Credit preferred stock for the stated value times the number of shares, so $100. And then we're going to credit additional paid in capital in excess of stated value for preferred stock. Okay, this one I didn't abbreviate, but you could abbreviate. And again, the formula, 100 shares times, in parentheses, $50 minus $1, so $4,900. Again, this is all, both of these are equity accounts. It's just changing the word common stock to preferred because we are organizing them. We want to show how much do we have issued in preferred stock based on its minimum value, how much is our stock being sold for over its minimum value. This right here. Oh, don't do that. Don't do that. Why'd you do that? Okay. How much common stock do we have? So we could have both. And this will be where I end. A company issues 1,000 shares of $5 par common stock for $20 a share. So that's its market value instead of saying trading for. And 500 shares of $10 par preferred stock, which is trading for $50 per share. So you could have them combined, and what you do is you just combine the journal entry. All right? So what you do What I'm going to recommend is you put the debit for cash and then you wait to solve. You credit common stock just like you always would, multiplied by the par value. So 1,000 shares times $5 a share. Then you credit additional paid in capital, excess of par for common stock, the difference between its market value of $20 a share and its par value of $5 per share. So the 1,000 shares times 20 minus 5, $15,000. Now you credit, same thing, preferred stock. Okay, so pretend like these are two separate transactions, but we're just putting them in one journal entry. So now you credit preferred stock for its par value. So we're only doing 500 shares of preferred stock, $10 per share, $5,000. And then we're going to credit additional paid in capital, excess of par, preferred stock. Again, we're only doing 500 shares of preferred stock multiplied by per share 50 minus par value 10. Okay, and that's the journal entry. All we have to do now, cash is going to be the combined value of all of these. So if you look down here, $45,000, we're going to debit cash for. Okay, so on the balance sheet, under the section of stockholders' equity, you'll see stockholders' equity on the balance sheet, and then you'll see underneath it, broken down just like this. Okay, now that's assuming that no other stock was issued during the year. But if it was, you would just make T accounts and you would update these values. But this is what the section of the balance sheet would look like. Just like that. Okay, so again, you join them together. Trying to think any last minute questions. Same process, you could issue them both, and instead of par values, they have stated values. If you want an official formula for the cash, okay, it's really just the combined shares of common stock. So 1,000 shares times the market value plus the combined $500 times the market value of preferred stock, $50, which is going to be the 45,000. Sorry. All right, so I'm going to end this video here. I'll give you your practice as always and your assignment. In the discussion post, I'll put a little post saying, ask me questions here, please. Okay? This way everyone gets the answers to the question. All right, I'm going to end it.